Today on the Joseph Carlson Show, it's been a busy weekend. The word of the weekend is tariff, and we've seen the outcome of this. We have a big market reaction. The market right now is actually doing okay, but it opened up heavily in the red, down around 2%. Right now, the S&P 500 is down just under 1%. We have the NASDAQ down 1.35%, and the Dow Jones only down 0.3%. Now, this comes after President Trump announced that he was imposing 25% tariffs on Mexico and Canada, an assortment of their goods, as well as 10% tariffs on energy. And the reasons why are debatable, but we've seen the fallout. Many people are concerned about this, concerned about the trade relationship, how this impacts the markets, how it impacts our companies. I announced very early on that I'm going to be buying this dip. Just like the title of the video, I've already bought the dip. And in this episode, we're gonna be going over which dip I bought, what company did I buy, and the reasons why. We're also gonna be going over this tariff business, the impacts it has, the power dynamics, and how it impacts different companies in your portfolio. So this is going to be a very interesting episode. Let's go ahead and jump in. Now, we first have to jump into the headline news that President Trump imposed tariffs on both Canada and Mexico. And there's been a lot of debate of the motivations or the reasons why. When I look at the news and I see that Trump has imposed tariffs, it's not surprising because he has been talking fondly about tariffs for quite some time. He likes tariffs. He thinks they're a great tool. He uses them as both a way to generate tax income for the United States and a way to impose some pressure on neighboring countries to get them to do what he wants. In this case, Trump has expressed concern about a couple things. First of all, the imbalance of trade between the two countries, between the US and Canada and the US and Mexico. And he's also expressed concerns about drugs, specifically fentanyl, making its way across the border. Now, looking into this, we know that the southern border has been a problem with drugs, cartels bringing drugs from Mexico, Honduras, Guatemala, all throughout Central America, through Mexico into the US. That's been a problem that's been around since as long as I can remember. Since I was a little kid, I remember politicians talking about the drug problem at the southern border. So it's no surprise that that was referenced as one of the reasons he was implementing tariffs on Mexico. But it did come as a surprise when he said that he was doing the same thing for Canada, for illegal drugs making its way from Canada into the US. Now, I was a bit skeptical about this. Is this a real issue, or is it just something that President Trump was using as an excuse to impose these tariffs? Well, as I was looking at this, I came across a video that was only a month ago. This was December of 2024. And what this video shows is Pierre, one of the leading candidates in Canada. In fact, he's expected to become the Prime Minister of Canada. He expresses his concerns about drugs in Canada, specifically in regards to tariffs.
The results are in on the Prime Minister's radical liberalization of hard drugs. He teamed up with the BC NDP to decriminalize fentanyl, crack, and heroin. He lowered jail sentences for mass producers of deadly fentanyl. And 80% of the fentanyl made in Canada is done so using ingredients that are not even regulated, but come right into our country where they're cooked into that poison, now threatening our trade relationship with the U.S.
So just a month ago, he was expressing real concerns about the decriminalization of drugs and how it could threaten the relationship at the border with the U.S. And it looks like those concerns have manifested. Now we have 25% tariffs on Canada, and one of the cited reasons, whether you believe it or not, is drugs entering in the US. More to this point, we also received good news from Mexico that the tariffs are being delayed by a month, as they agreed to send more troops to the border. This news is good because it signifies that President Trump is willing to make agreements and remove the tariffs if certain concessions are made. Now, as we look at this and the potential agreements in the future, there's a couple ways to break down the impact of tariffs. And this moves into why I'm buying this dip. I want to go through the major points of why I think any dip we get with tariff news is a buy. Whether it comes this week or next month or the month after, anytime President Trump implements tariffs and it causes the market to go down, I believe that's a buy. This is the reason why. Now, as we go through this, I want to clarify a few points because there's a lot of incorrect information being passed around online. First of all, what are tariffs? Tariffs are simply a tax on the imports or exports of goods from a different country to another. Now, because tariffs are a tax between two different parties, and there's a lot of different factors like supply and demand and economics at play here, it's very unclear who actually pays the tax of the tariff. We don't really know who pays it. And that's why there's so many arguments going around on who pays it. It's the same problem we have with corporate taxes. Consider this for a minute. When a corporation is taxed, who's paying that tax? It goes to the corporation, so the corporation's paying it, but a corporation is the formation of three different groups of people, three different parties. The customer that pays for the goods and services, the employees that work at the company that receive a salary, compensation, and benefits, or the shareholder. When the corporation's taxed, one of those three parties pays for it, but we don't know which one. Maybe the customer gets higher prices. Maybe the employee gets less benefits or a smaller salary. Maybe the shareholder gets a smaller return. But we don't really know. It's kind of unclear. And that's why taxes on entities like corporations are very ambiguous of who's actually paying. The same type of problem exists with tariffs. When we implement the tariff on Canada, is it the US citizen paying for it through higher prices that Canada raises their prices of their goods they're selling? Or does the US benefit because they get the tariff money? Even politicians and economists have a difficult time understanding who pays the burden of a tariff. It can be different in different situations. So that part is unclear. Now, another important part of tariffs in this case is all of these tariffs from President Trump are being implemented by executive order. That means that he just waves the magic wand. He just signs a paper and boom, you got yourself a tariff. The tariff through executive order. Executive orders are inherently short term. Executive orders bypass Congress. They're not written into law. They can be signed and unsigned. They can be slapped on and taken off with the signature. And that's why President Trump has implemented dozens and dozens of executive orders as soon as he got into office. Any president can do that, and they can change them just as quickly. But the important point here is that unlike laws passed by Congress, which are very difficult to get changed, executive orders are inherently short term. They can change at a whim. Now, we get to the main point here. And that is the outcomes that exist. And this is where I look at the most reasonable outcomes from this exercise. Only a few viable outcomes exist from this. The first one is the tariffs result in concessions from other parties and are taken off. I wrote this before the news broke that Mexico had taken off the tariff. This news just broke a few minutes ago. The tariff is gone for at least a month because they made some concessions. That is one of the most predictable outcomes of this tariff, is that Trump is using it as a negotiation tactic to put down real pressure on different countries to get them to make some concessions. The other likely outcome is that the tariffs end up hurting the US economy, hurting the US consumer, and they're taken off. President Trump doesn't need to leave them on. They're not laws. So if he was finding that they weren't working out, there was no concessions being made, and they were causing a net negative to the US economy, he would just take them off. Again, they're easy to change. You can put these on or take them off on a whim. And then finally, the only other outcome I can see is that the tariffs are beneficial for the US and are left on. If he leaves them on and they're actually helping the US economy, helping the stock market, then he might just keep them on. But either way, this is all short term. All these outcomes are inherently short term. The only outcome, the only option that's long term is if tariffs are helping the US economy and the stock market. The only viable outcomes for these tariffs are short term. The long-term viable outcome means that it's good for the US economy, and therefore this is a buyable dip. There's no situation where buying a dip because of tariff concerns is the wrong choice to make, at least realistically from what I can see. Now, the other considerations that I look at is how my companies react during market chaos, turmoil, recessions, and all sorts of problems. We can look at history and study what these companies do. In terms of what happens during market chaos, for example, we can use the COVID years. Look at what happened during my key positions during the COVID years. COVID happened, and Netflix gained more subscribers than usual. Netflix is now in a stronger position because of COVID, because of the market sell-off, because of the panic, than they would have been otherwise. It helped the company, it didn't hurt them. When we look at what happened to Amazon, Amazon gained market share during the panic and the sell-off. And Amazon does this every time. Every time there's large market scale panics, sell-offs, recessions, Amazon explodes in market share because they're the lowest cost, most convenient place to get goods. So they benefit. Another retailer that benefited dramatically during at least the COVID sell-off is Costco. This is a company that thrives during market chaos and panic. These companies, all three of them, are stronger today because of COVID, because of the 2008 recession, than they would have been otherwise. They gained market share during this panic. Another company that seems weak but actually benefited during the COVID panic was Texas Roadhouse. Texas Roadhouse's sales plunged when all the stores were shut down and the restaurants were shut down, but its scale kept it profitable while competitors went bankrupt. We can look at this in the financials. If we look at Texas Roadhouse and what happens during market panic, you can see the dip during the COVID year. That was a big problem. It was scary. The stock plunged. So investors were really concerned. But what happened after the COVID dip? Growth actually accelerated because during this dip, weaker companies went bankrupt, making it so that Texas Roadhouse gained market share. All the would-be customers of those bankrupted restaurants started to eat at Texas Roadhouse. Now the growth is at 14% per year, which is faster than its historical average. We can even look at the example of Booking Holdings. This is considered a more risky company, one that's a little bit more susceptible to market sell-offs. What happened to Booking Holdings during the COVID pandemic? All travel was shut down. Their net income went down, their revenue went down, all of the metrics plunged. During this time period where people are panicking about vacations, it was building up demand. It was like it was being bottled up. Demand for vacationing was never higher. So as soon as the regulations were relaxed, when people felt safe again, vacationing took off, and sales are now much higher than they were preceding the sell-off. In every case during these type of events, during market panic, during sell-offs, during recessions, these type of companies get stronger. They are stronger than they would have been if there was no panic to begin with. So not only does this create great buying opportunities where you can buy the dip knowing that it's going to go right back up, but you also know that even if it gets worse, even if the dip goes down even further, even if it has material effects on the companies temporarily, overall it's going to make them stronger in the end. This is what Nassim Taleb refers to as anti-fragile. It's not just that these companies can endure a sell-off, but they actually get stronger during a sell-off. So I'm not concerned about this sell-off at all. I wasn't yesterday, I'm not today, and I won't be the next time we get a tariff scare. Every viable outcome leads to it being temporary or to it being beneficial. They are inherently temporary because they're executive orders. They're not laws passed by Congress, which are very rigorous and difficult to change. And it's known that Trump uses pressure. He uses big tactics like this to get concessions out of other countries. We had a president that didn't really do that much, and now we have one that does. And you can complain about it or you can be excited about it, but either way, that's the situation. President Trump is not afraid to use these type of levers that the US economy has to try to get other countries to do some of the things he wants. And frankly, we've seen other countries do stuff that's somewhat similar. Every time I post a video saying that I don't like a lot of the regulations that Europe has, a lot of the fining of big tech companies, the siphoning of billions and billions of dollars out of US big tech companies, there's a lot of people quick to defend them, saying that's their right to do. And if you don't like it, you can leave. You don't have to do business in Europe. And that's similar to what the US is doing now, using a little leverage, applying it to different countries to try to get them to make concessions. Now, I've had a very consistent opinion on this for a very long period of time. I don't like high taxes. I don't like tariffs. I don't like it when countries try to make it difficult to do business in their country. I'm for low taxes, free trade, and few but smart regulations. That's what I'd want if I was a European. That's what I'd want if I was in Canada. It's what I'd want if I'm in the US. So either way, whether it's Trump implementing it or anyone else, I don't really like tariffs, and I'm hopeful that we can make some agreements so that the tariffs don't stay on. But either way, I'm not the president. I'm not the one making the decisions here. President Trump has every right to use this as a lever, as does the EU to use their regulations as levers. Now, there's been another group of people that are acting very poetic about this, like Canada and the US are no longer friends. We're no longer allies because of this. How dare the US do this to Canada? Come on, this is like a family feud. It's like a little disagreement. You think we're not going to be allies? You're going to go ally with China now because of a tariff? These takes are ridiculous. This is short-term by nature. This is not something that's going to stick around. In 3 months, nobody's going to remember this. Just a week ago, all anyone could talk about was DeepSeek. And that news is completely dead with this. So there's going to be some big thing that comes along. The relationships will be fine. This is a tool that's being wielded. Now, in terms of what I'm buying during this dip, I think that there's lots of good buys. But when I did my review of my sentiment on different holdings. This is a comprehensive list that I released on my Patreon. This is an exclusive. I'm going to be going over an exclusive video on this, but one of the companies that I identified that I currently own that's still undervalued is Booking Holding. Booking Holdings was down 10% over the past month, and just today it was down around 1% this morning. That's when I bought into it. I bought $5,000 more of Booking Holdings at a share price of $4,646. Now, if we look at Booking Holdings today, it's already up around $100. So this was a small dip that was taken advantage of. When I was refreshing my analysis on this company, I noticed that the stock had dropped 10%. The valuation and forward multiples seemed rather cheap. It trades at a 22 forward PE ratio over the next 12 months and a 19 forward PE ratio based on 2026 estimates. That on the surface is very cheap. The trailing free cash flow yield is 5%. Booking is positioned to do buybacks of over $8 billion per year. So again, when we look at this company, the metrics are pretty astounding. We have very inexpensive forward PE ratios. We have a very high free cash flow yield for an excellent asset-light company. A company that's so asset-light, it has almost no stock-based compensation. Check that out. Only $500 million of stock-based compensation on $8.5 billion of free cash flow. The free cash flow per share is growing at a rate at around 20% year over year. The S&P 500, for example, grows at a rate of around 8%. So this is growing over twice as fast in its intrinsic value over the S&P 500. Over the trailing 12 months, they paid back $7.7 billion to investors through buybacks and did another almost $1 billion through dividends. This is a company that makes a fortune, they're super profitable, and they return that right back to the shareholder. So I don't believe that Booking Holdings is the only good buy in this market sell-off. There's lots of candidates, but when I reviewed the holdings, this is one that I really want to increase my position. I love the low valuation multiples. I love the return of capital to shareholders. I love the fact that the business model is very insulated from what's going on right now, and I think it has a very bright future. So I'm increasing my holding in Booking Holdings, and I'll do the same for every tariff-related sell-off. Because as far as I'm concerned, once again, this is going to prove to be a buying opportunity. That's all for now. See you in the next one.